Investment Committee meeting to order. The first order of business will be to call the roll.
Rob Fechner.
Good morning.
Margaret Brown. Here. Dana Hollinger.
Excused.
Henry Jones. Here. Fiona Ma.
He's coming.
Fiona Ma, represented by Frank Rufino.
Present.
Lisa Middleton.
Present.
David Miller.
Here.
Irena Ortega. Here. Jason Perez. Mona Pascual Rogers. Ramon Rubacavla.
Here.
Teresa Taylor. Here. Betty Yee.
Thank you. The next order of business is approval of the May 13th timed agenda. What's the pleasure of the committee?
So moved.
Then moved by Miller, seconded by Taylor. All in favor say aye.
Aye.
Opposed, no. Motion carries. Item 3 is swearing in ceremony for new board members. Mr. Jones, would you please swear in our new board member?
Thank you, Mr. Fechner. Before we get started, I'd like to extend my congratulations to our newest board members, Irena Ortega and Lisa Middleton. And Ms. Ortega serves as the ex-official member of our board, and she is the director of CalHR. Ms. Middleton was recently appointed by Governor Newsom as our local government elected official. She is a Palm Springs City Council member. As is customary, we will now have a brief ceremonial swearing in of our two new members. So Ms. Ortega and Mrs. Middleton, would you please join me over the side of the dais? Guess one can stand here, one can stand here. All right. Okay. Okay, great.
Like a trio going to sing.
Okay. Let's get this. Okay, please raise your right hand and repeat after me. I, then state your name.
I, Lisa Middleton,
Do solemnly swear, and I will support and defend the Constitution of the United States
do solemnly swear that I will support and defend the Constitution of the United States
and the Constitution of the State of California
and the Constitution of the State of California
against all enemies, foreign and domestic,
against all enemies, foreign and domestic,
that I will bear true faith and allegiance
that I will bear true faith and allegiance
to the Constitution of the United States
to the Constitution of the United States
and the Constitution of the State of California,
and the Constitution of the State of California,
that I take this obligation freely
that I take this obligation freely
without any mental reservation or purpose of evasion,
without any mental reservation or purpose of evasion,
and that I will well and faithfully
and that I will well and faithfully
discharge the duties upon which I'm about to enter.
discharge the duties upon which I'm about to enter.
Okay, thank you for acknowledging your commitment, and we look forward to working with you and with you serving our 1.9 members. Okay, thank you very much. Okay.
Congratulations to you both. Item 4, the election of the chair of the committee. For that, I call on Mr. Jones.
Thank you, Mr. Fechner. The item is to elect the chair of the investment committee because, as most of you know, Bill Slayton was replaced by Ms. Middleton on the committee and on the board, and so we now have to elect a new chair of the investment committee since Mr. Slayton was the chair of the committee. So with that, I will now open the floor for nominations for chair of the investment committee. Mrs. Teresa Taylor.
Thank you. I would like to nominate our vice chair, Rob Fechner, to chair of the investment committee.
Okay. Are there any further nominations? Are there any further nominations? Are there any further nominations? Hearing none, I would entertain a motion to appoint Mr. Fechner as chair of the investment committee by acclamation. Moved by Ms. Taylor.
Second.
Second by Ms. Arena Ortega. And so all those in favor say aye. Aye. Opposed? Hearing none. Congratulations, Mr. Fechner.
Thank you. Thank you. Thank you, everyone. We're certainly going to miss Bill and his wisdom on this committee and on the board, so we wish him well in his new endeavors. Now opens up the election for vice chair of this committee. So I'm now going to open the nominations. Mr. Rubalcaba.
Thank you, Mr. Chair. I'd like to nominate Ms. Teresa Taylor as vice chair of the committee.
Okay, Ms. Taylor's been nominated. Are there any further nominations for the office of vice chair? Any further nominations for the office of vice chair? Third and final time, any further nomination for the office of vice chair? Seeing none, I'll entertain a motion for a unanimous ballot for Ms. Taylor for vice chair.
So moved. Second.
Moved by Ms. Ortega, seconded by Ms. Pascal Rogers. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Congratulations.
Thank you.
We're going to take a short 10-minute recess right now to give staff an opportunity to rearrange the dais. So hold your seats close. Won't be long. All right, thank you for your patience. They got it done quicker than we thought. I do want to say it was kind of like the first day of a college class, but you all sat in the front row, and that doesn't normally happen. So It was too awfully quiet. Before we move on to the agenda, I'm going to take a moment of personal privilege and call on Mr. Perez. You push your button, please, Jason. Thank you. There you go.
Thank you, sir. I'm wearing my uniform this week. This week is National Police Officers Memorial Week. 177 police officers were killed in the line of duty last year throughout the United States, and 10 of those were here in California. So that's why you see the black band over the badge to memorialize those men and women that died serving our great state.
Thank you. Just thought it was important for everyone to understand why he was wearing a uniform on the dais today. So moving on with the agenda, agenda item 5 is the Pledge of Allegiance. I've asked Ms. Ortega to please lead us in the pledge.
Pledge allegiance to the flag
of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Agenda item 6, Mr. Meng.
Good morning, Mr. Chair, members of the Investment Committee. Agenda item 6 is an action consent item.
So what you have before us right now is the minutes from April 15th. What's the pleasure of the committee? Moved by Taylor. Seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye. Aye. Opposed, no. Motion carries. Please show Ms. Middleton as abstaining. Item 7 is an information item. I have no request to pull anything off of the information agenda. We have 7A. Mr. Meng, anything on there?
Yes.
Thank you.
Before we continue the discussion with private equity co-investment, with your permission, I would like to share a piece of very exciting news about personnel. As you know that as part of our investment belief, we manage or we look at our portfolio companies and manage 3 forms of capitals: financial capital, physical capital, and human capital. For CalPERS as an investment, I view them as an investment management organization. The most important asset we have is human capital. So on that note, I would like to share with you that after a very extensive and competitive search, we have selected Mr. Greg Ruiz to be the managing investment director of private equity. And he is with us in the audience today. I would like to have him to stand up in the audience and to be acknowledged. Greg has worked his whole career in private equity, most recently as a principal at Altamont Capital Partners, based in Palo Alto. He has also worked in private equity at FFL Partners in San Francisco and also at Goldman Sachs. Greg understands the complex nature of the asset class and will be a wonderful addition to our team when he joined us this summer. Well, Greg moved to the East Coast to attend Princeton for his undergraduate degree and lived in the Bay Area while getting his MBA at Stanford and throughout his professional career. So coming to CalPERS is actually like coming home. He grew up just down the street in Davis. He also has a very personal stake in CalPERS. Some of his family members are CalPERS members, so his commitment to our mission is already very strong. And at this time, I also would like to take this opportunity to thank Sarah Kaur for her work as interim management investment director of private equity. Her leadership and skills have been essential to the success of the asset class, and I cannot thank her enough for all she has done. In addition, I also want to thank the entire private equity team for their excellent work as we searched for a new MID. Their commitment to the fund, even in these times of transition, has been exceptional and fundamental to our success. I look forward to their continued contribution as we go forward with our work on behalf of our nearly 2 million members. So with that, back to the IC chair.
Thank you. Appreciate that. So I think we're ready for you to move on with your
discussion
agenda items, sir.
Yes. slide, please. Yeah. So as you may recall, last month at the investment committee, we presented 2 items to you on a similar topic, which is the co-investment, a review of the co-investment activities in private equity. And the 2 items, one was in the open session, where we talk about, generally speaking, what's the current market practice and what are the risk-return profiles and considerations around co-investment in private equity. Then in the closed session item, the second item, we discussed our CalPERS performance, our approach in the past, and our observations of our global peers. How they are approaching co-investment in private equity. So today is in effort of bringing part of the closed session discussion to this body to be discussed in public format. So with that, we have 3 brief topics. Can I have the slide, please? So we'll briefly talk about the history of CalPERS co-investment, then followed by the performance of our co-investment, and we will conclude with our observations. What are the success factors in managing co-investment in private equity? So if you look at the history of CalPERS co-investment, I would like to break it down into 3 eras. So the first era is really in the 1990s. We started our first co-investment actually in 1993. So we have had more than 25 years of experience in private equity co-investment. But in the first era, in the 1990s, we did not adopt or did not develop a systematic effort. And we made 1 or 2 co-investments a year in the 1990s. Then the second era is really in the early 2000s. We continued with the opportunistic approach, and we were in out of the market. And there are some years with no co-investment, as you will see in the chart on next slide. And then the third era is in the 2010s. That's where we started more dedicated co-investment effort, and we began to see some better results from co-investment. The program was suspended in 2016. This slide shows the performance and also the amount of capital deployed to co-investment since 1993. So as you can see that the first year in the 1990s, we didn't do a lot of co-investment. And the second year in the 2000s, we continued with the opportunistic approach. And then from early 2010, 2011, 2012, we started a more dedicated approach. And the darker blue bar is the cost, and the lighter blue bar is the total value. So as you can see, particularly in the early years, there were a number of years that we lost money in co-investment when the total value of the investment is lower than the cost. So more importantly, what we have learned, what observed from our global peers as well, how to manage a successful co-investment program in our private equity. So first, the first 2 bullet points is really about our approach. For a long-term investor and long-term strategy, we need to develop a more consistent approach to co-investment. And also we need to, on the same note, we need to commit to steady deployment regardless of the market cycle, because market timing is very difficult. So again, for a long-term strategy, for a long-term investor, we need to adopt a steady deployment of a capital approach, regardless of the market cycle. The third bullet point is about portfolio construction. Well, what we learned is that it's very important to build a diversified portfolio by in the co-investment approach, the diversification by vintage year, by manager, by industry sector, as well as by geographic areas. The fourth bullet point is about how to select the partners in co-investment. It is important to partner with managers that have a strong track record of the deal, of the co-investment deal that they are offering to us. And the last bullet point is about how, as we know that co-investment is becoming more and more popular, as more and more investors like us demanding more co-investment. For us to improve our competitiveness in the co-investment universe, we need to continue to establish our credibility with the GP, the managers community, by demonstrating and delivering a methodical and quick and consistent process so that we can respond to co-investment opportunities in a timely manner. So with that, I will pause for any question that you may have.
Thank you, Mr. Meng. One question before I move on to board members. How do you plan to staff the co-investment part of your program? Do we need to hire more people, or are we going to rearrange current staff?
Very good question. Currently, we don't have an answer how to get more staff. We will need more staff in private equity. So just at this morning, we were having the senior management team was having a group discussion with the entire private equity team, and one of the questions came up is about staffing. So private equity will need more staff, and we will work with once Greg joined the team, we'll work with Greg and Sarah continually to develop a staffing plan as well.
Thank you. Ms. Brown.
Thank you. I want to start with page 4 of the slides. So I think we heard last month that we had sort of started staffing up in 2011, 2012, and then we saw success, it looks like, in 13, 14, and 15, and then you said we've halted co-investments in 2016, but we didn't actually say why we halted. So can you tell us why we stopped? Because it looked like, it seems odd that we would stop something that was successful.
Thank you. My understanding is that during that time, the investment office was conducting a review of the private equity program. And as what we see now, the part of the new business model, the discussion really started back then. And then the investment office decided at that time was prudent to stop the co-investment program as part of the overall review.
Yeah, well, I might disagree that it was prudent, because it looks like we stopped something that was very successful, and it may have harmed our returns, actually. Let me go on to page 5, then, the slide 5. You know, you talk about a commitment pay, that consistent commitment or a pace is essential for success, but why would we consistently buy when prices are high instead of when prices are low? Because I'm sure you're not saying that Mr. Warren Buffett is wrong.
I don't know your reference to Mr. Warren Buffett, but as a human being, I believe there are times that he will be wrong as well. But my point to this is your question about the consistency. There are two aspects to it. For one, market timing is very difficult. For all of you, I'm sure you read financial journals. How many times we have, and how long we have been hearing that's the end of the cycle, the end of the cycle, the end of the cycle. So market timing is very difficult. And also, the renowned economist, we all know, Paul Samuelson, once said famously that market timing is a sin. So it means very difficult to do. The other benefits of a steady approach to a long-term strategy is something we call dollar averaging. So when the market is high, you deploy the same amount of capital, and then when the market is low, the valuation low, you deploy the same amount of capital. But when the market is low, the share you are buying with the same amount of capital is higher, the number of shares, than the number of shares you would be buying when the market is high. But overall, over the long term, if you do a dollar averaging, you will come out ahead, just mathematically speaking, dollar averaging, because you bought more shares at a lower price than the shares at a higher price. So that's why it is important, in absence of any market timing skill, to deploy a steady approach to a long-term strategy.
So in January, you know, in your presentation to us, you talked about being more or less aggressive depending on the opportunities, and I really like that answer versus this answer today. So I'm hoping that's what we're going to stick with, is sort of being more aggressive when we see the opportunities. I assume we have a new manager coming on board, and we'll probably have more discussions about that.
Yeah. So I totally agree with you. What I said in January and today is they are consistent at the approach. We'll be more aggressive where we see we have a competitive advantage, and we see we do have a competitive advantage in private equity and in co-investment. That's where our scale and brand really come in to benefit us. So that's exactly consistent with the spirit of my talk in January.
Thank you. Just a few more questions. Mr. Chair. We also talk about hiring or working with managers that have a track record of success, but from my reading, all the data suggests that there is no persistence in quartile rankings.
The analysis of research I have seen, you see more consistency in manager performance in private markets than public markets. So again, as I said in the past, one of the challenges with private market is a lack of data and lack of transparency. So it really depends on what data, what source of data you use, what time periods you choose. The study results vary drastically. So we read a lot, again, we read a lot of financial reporting, researches. Particularly when it comes to private markets, I really caution everyone, myself included, be very mindful of the source of data and the time period. As you can see, the time period can have a significant impact on the study results.
Okay, so if you have any recent data that tells us that we should rely on successful managers, would be happy, in private markets, be happy if you would share that with me. And then to piggyback on what the chair asked about in terms of building staff, and so my question was going to be, how do you propose getting skills, co-investment skills, on our staff? And so I hear you'll be working on a plan and hopefully sharing that with us in the future. I just think it's critical that we staff up and develop those skills as we move forward. I just think it's a shame that we abandoned something that was working for us in 2016, and maybe we can get right back to where we were and keep on growing.
Yeah, if I may, I would just like to remind everyone, myself included, in hindsight 2020. So in what happened in 2016, back then, given the information was available back then and the consideration back then, in investment, it's very difficult and even very dangerous to look at things in hindsight. It's just did we make the best decision given the information we had and constraints we had and the considerations we had back then.
It'd be helpful if we had anything in writing. So as we move forward with a strategy or we abandon a strategy, it'd be great to have a white paper or some sort of report or something in the files, because as I read back, I wasn't on the board then, but as I go back, there's nothing in writing about that. It seems like it was more conversations that happened in closed session, and it'd be helpful to have something to document why we abandon a strategy or we move forward with a strategy. Thank you.
Thank you. Ms. Yee.
Thank you, Mr. Chairman. Thank you, Ben, for the overview. I just had a couple questions. We haven't talked about fees yet, but wanted to just get your sense of if you could provide some flavor as to how much you anticipate both the average co-investment commitment to be compared to the current GPLP commitments, and then also your anticipation about how much lower fees might be.
Yeah. Thank you. So usually in the markets, the fee structure is we call 220, so 2% managing fee and then 20% carry or the performance fee. But again, because of our size and brand, so on average, and also the drive by the team in the past years, in the recent past, we have been able to drive the fee lower than the market standard. So that's on the pillar 2, or what you call the traditional fund investment business. On co-investment, normally we get is no fee, no carry. So all right, saving right there, and that can be quite meaningful actually.
Good. Okay. Good. Thank you. And then, are we going to be presented? I guess I'm wondering if there's a proposed pacing plan for co-investments that you're going to be developing.
Yes, we're working on that, and we hope by June or next month we can bring something to you. But depending on the team is working, has been working tirelessly. Yeah. As you know from last month, the closed session discussion, the team did a lot of original work ourselves on this very important topic. So we do plan to come back to you with a plan when we are ready in the very near future.
Okay, great. Thank you very much. Thank you.
Thank you. Ms. Pascal Rogers.
Thank you, thank you, Mr. Chairman. Thank you, Ben. So I just want to clarify, because I might have missed it, but back in 2016, when all these decisions were made, the staff has completely changed since then, right? I mean, I don't think that you're all new, you're all, right, and you're still trying to hire. So I just want to make sure that it almost sounded like, you all were responsible for that, but you're not, because you're all new and you're bringing on new people, right?
Correct.
All right, thank you.
I'm sorry, just to step in really quickly. There's been a great deal of turnover. I do want to, just in the interest of accountability, I was on the ISG at the time. There were other members, but yes, there are a number of new, including, most importantly, the CIO.
Yeah, so you're right, the key leaders, the head of private equity and the CIO has changed.
Right.
And plus a few other senior rank. But Dan is absolutely right that there are a few senior members on the investment decision body still here today.
Great, thank you.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, thank you, Ben. I was just looking at your success factors, but a couple of more come to mind I would like you to comment on. And one is greater transparency, because I know there was quite a bit of discussion surrounding the fact that we're going to have less transparency, but and differentiate between transparency for this CalPERS and transparency for the public.
For the public.
And also, if you could comment on the alignment of interests, how that's going to be improved with this new concept.
Yep. So on the transparency, if you compare co-investment with the traditional fund investment, on both transparency and control will be increased to us, to CalPERS, to the investment staff, so that we can make better investment decisions and in the hope of deliver higher return for our beneficiaries. However, for that to happen, the enhanced transparency and control is only to CalPERS, not to the general public. The reason that we will have enhanced transparency and control in co-investment, because we are a little bit, we have more time and will be involved in early stage of the deal structuring process, in the investment process, than the commingled fund approach. So we have more lead time into it. We will, depending how we approach co-investment, as I showed you not yesterday, last month, feels like yesterday. As I showed you last month, there are different approaches to the co-investment. And you can be very involved early on. It's co-lead or co-underwriting, or we can wait until later in the syndicated approach. But even the syndicated approach will have more transparency and more control than the commingled fund, than the majority of our fund now. So that's our first question on transparency and control. Sorry,
alignment of interest.
Oh, the alignment of interest. So here's alignment of interest is that, if you may recall, last month we reviewed why GPs or general partners offer co-investment to LPs, and then why LPs want co-investment from the general partner from GPs. So the reason, one of the reasons or main reasons GPs offer co-investment is really to strengthen their relationship, building strategic partnership with selected LPs. So in that case, if we understand their motives, if they are offering co-investment opportunity to us because they would like to further develop the strategic partnership with us, we kind of aligned on the motive. And then on the fee, once we save the fee, no carry, that gave us a lot of margin for cushion, margin for cushion. The other alignment is that think of the co-investment mostly happens when the deal size is larger than the risk policy of the commingled fund the GP runs. And usually the bread butter business for GP is their flagship commingled funds. So if the deal is in the commingled funds, it means a lot to them and to the future of the firm. So that's another alignment of interest there. The other one is that, as I said, we'll have more control. Co-investment, we will have a say whether we want it or not. Is that in our desired sector or geographical strategy or not? So we'll have a say whether we want the co-investment in our portfolio or not. So in a way, we can create another additional layer of alignment interest with our portfolio objectives.
Okay, thank you.
Thank you. Ms. Taylor.
Yes, thank you, Mr. Chair. So I had a couple of questions, Ben, and thank you so much for your presentation. I know you're going to be hiring more staff. since we stopped in 2016, we still have some co-investments, right?
We still have co-investment in the portfolio, but we stopped doing new co-investment
Right.
from 2016. You are right.
So we still have some relationships.
We do.
Okay,
Yeah.
so the team that you have currently is working with those GPs right now.
Yep.
Okay.
And the current team has some capability in co-investment. It's just prioritization,
Right.
what we would like them to work on.
Okay,
Yeah.
okay. So then, and then we'll be hiring more. So you're allocating more resources.
To private equity.
Okay.
That's the plan.
Then, excuse me. As you talked about the co-lead and the co-underwriting, how do we decide to make that decision if we determine we want to do one of the three?
Yeah. So that's to come either in June or in the later months. So once we develop the strategy, as I was answering Controller Yi's question, we'll be coming back to you very soon.
Okay, and that strategy will include whether or not you want to go in as a partner, as a co-lead, a co-underwriter. But wouldn't that change with each partnership?
It can.
Okay.
It can.
So the strategy would be an overall feel amount, and however it's being presented to us, and whether or not. Okay. And then finally, I want to make sure alignment of interests include our ESG strategies and our investment beliefs. So I'd like you to kind of opine on that a little bit, as I know, and as you know, that our private equity sometimes has a tarried past.
We all care about issues like ESG, and in private markets, actually, because we can have more control, means that we can have more influence. And this is, again, as I just mentioned to answer Chairman Jung's question, that we'll have additional layer or more control in this strategy in terms of what's in our portfolio. So we will be happy to look into in the co-investment activities, how do we incorporate our ESG goals as well.
So and my concern is I just don't want to see us, while I agree we want to be aggressive, I don't want to see us be so aggressive that we're getting ourselves involved in a situation that could end up like a Toys R Us situation or Sears situation, because it hurts our brand, and that's a risk to the fund. It also, ends up being a loss for us. So,
noted.
Thank you, Mr. Miller.
Yeah, thank you, Ben. I think most of my questions have been addressed, but I will circle back to kind of my broken record kind of comment is I really appreciate this. I'm really looking forward to the work of the team and the planning, particularly in the context of kind of a more, I hate the word strategic, but more of a mid-horizon or longer-term workforce talent flow management kind of planning. And of course, we're doing our budget now, but I think we'll see this ultimately alignment in future revisions and budget as well. So I'm looking forward to that too.
Thank you. So on that note, if I may, since you mentioned budget and a number of you mentioned about resourcing, so private equity, it is a more expensive asset class in both of terms of resources, the type of talent, and budgeting, travel, due diligence. So we are very grateful for your support. It is has been, and we believe will continue to be, the highest returning asset class, but almost like everything else in the market, in life, is also a more expensive asset class as well. So thank you for your support.
Thank you, Mr. Perez.
Thank you. Ben, I had asked this question before, speaking about the alignment of interest, specifically in regards to the ESG, and I thought the answer then was, the focus is the return on investment. So I don't. The ESG component is important so much that it evaluates our risk, but I think that the goal. I'm sure the goal. I want to hear you say it again.
Yes.
Makes me feel better.
So
the goal is just to make us money.
Yes. So yes, but let me put a little bit caveat there. So risk-adjusted return, and ESG can be a risk. It's not as well understood as the definition of risk in the financial markets. We define it as volatility or the uncertainty of a return. That's really around the financial return, and but the ESG. Let's think about the climate risk. It's a little bit longer term than what we see now, is whether the GDP number is higher or lower than expected. That will move the market right away if there's a surprise in the underlying economic data. But certain risks are a little bit longer term than what we see. But as we're a long-term investor, we should bring other considerations such as ESG, as how soon and with what kind of certainty it will translate into financial risk. So that's the way I answer to your question. Yes, in that sense that we're looking at a risk-adjusted return. But the risk, again, as in our investment belief, is multifaceted, and not just the financial risk definition of volatility. And if we know the history of the financial literature, that was introduced by Dr. Henry Markowitz in the 1950s. But before the 1950s, the discussion of risk was not as prevalent. People knew return, but didn't know the risk, but didn't know how to define it or quantify it. My point is that in 1950s, when Dr. Markowitz defined risk as volatility, even though it's not perfect, but as a simple and measurable risk, it took off. And since then, the entire financial literature and the majority part of the asset management industry is running on that limited definition of risk. So we need to be mindful of the historical context of the financial risk, how it came about, and the imperfectness of that definition. So risk is multifaceted, and other sorts of risk, even though it will be further down the road in the horizon, it may translate into financial risk in the near term. So that's how we monitor all the risk together.
I understand the climate issues, the risk, and your need to assess that. I think I have a little more heartburn with the social issue risk.
Social risk. Let's put it. If you break down E, S, and G. So the G component, the governance component, we have experts here in the audience, Beth and Ann Simpson in the audience. So let me take a first step. If you guys are not satisfied with my answer, we'll call on the true expert. So the G component is better understood, and there's more data to support it. Would better governance lead to stronger long-term performance? And I believe there are some evidence. On the G and on the S, the definition of social, if you talk to 10 different investors, probably you get 20 different definitions of social. So that is an indication of the early stage of that development. And then on climate change, we have seen some really drastic change in climate patterns. The question really to us, I agree with all of you that we put on our fiduciary hat is risk-adjusted return. So how much data or conviction we have of that data, assessing that risk compared to the risk in front of us, and how do we do a trade-off? What's the framework? So on that topic, Beth and I actually, we have had a number of conversations developing a trade-off framework among all the different risks. So now, yes.
So Beth Richtman, CalPERS investment staff. So I think I'll respond in a way that addresses both Mr. Perez and Ms. Taylor's question about co-investments. So last week, we actually had a private equity manager in our office, and it was interesting because they talked about how they were looking, in particular, at certain social factors when they underwrite investments because they're concerned about the returns. And a couple examples they gave were one that was a company that was a brand that was consumer facing, that when they did their due diligence, even though it looked like a very attractive investment on the face of it, they found that going deep into the supply chain, that there were actually labor relations issues and actually child labor issues within that supply chain that they saw as a huge risk to that brand. And they couldn't get their own pricing and decided not to touch it, and they walked away because they saw that as a material risk to the investment. And if they hadn't been looking at the S part of it, they wouldn't have necessarily seen that. So that example captures two S topics which are important. One is on the labor side, the risk, and understanding the workers within the company, but it also expresses something which is the consumer sentiment about these type of topics. Consumers care more and more about the type of products and services they're taking, the companies that produce them, and so that brand value matters a lot. And so as an investor, when you're underwriting a company, you tend to put a lot of value on the brand of some of these companies. And so things that could imperil the brand matter a lot when you're underwriting investments. Relatedly, they also talked about looking at certain companies that would supply to big big customers or corporate customers, like say a Walmart, that now have very strict guidelines for the types of products they're buying. I mean, they're very much looking at the chemicals, they're looking at the carbon footprint of the products they're buying. And so if companies have, say, are selling to Walmart as their major customer, if they're not thinking about the carbon footprint of their products, they might be excluded from that giant market. And so these are issues that affect the value of private companies and that we need to make sure we're looking at. And one thing we're doing in real assets, for instance, that SI recently updated with the real assets team is we have these ESG consideration matrices when we underwrite real estate and real assets. And those help guide that team in pricing these risks. And I think tools like that can be utilized in the private equity process as well to help make sure that our staff is aware of those and that our external managers are making sure they're factoring these topics in.
Thank you.
Mr. Jones? Thank you. Ms. Taylor?
Thank you, and I just want to thank Ben and Ms. Rickman for their explanations. And I also wanted to just go a little bit deeper. When we look at the S on the ESG, we already have an example for ourselves where we lost money because of the S on the ESG, and the G, actually, because we were invested in a fund where Toys R Us was one of the companies they were invested in. They bankrupted the company. The governance of the equity fund was questionable to me. And we lost money on that. The reputational risk for that for us is bad because that hurts our reputation, and it hurt the reputation of the private equity fund. So and it was a governance issue as well as them not treating their workers well. When they closed the company, they ended up with a whole 33,000 unemployed workers. And that's just not a good look for CalPERS to be invested in, number one. But number two, it hurts the fund. It's a risk to the fund. We lost money on that. So I just want to be clear, that's kind of what I was referring to. But Ms. Rickman did a very broad definition of that, which is helpful as well. But I think when we can see these examples, my concern is that we don't get involved in a company that's going to take money out of that company for the CEOs, close down the company, and put 33,000 workers out of work, which is where we need to be very wary of. So I appreciate everybody's help with that. Thank you.
Seeing no other requests, back to you, Mr. Meng.
Thank you. So the next agenda item is let me open my binder. I know it's the CFA. We have esteemed guest with us today from CFA. We also would like to thank our CalPERS colleague Ann Simpson for her help and contribution to this project. So with that, let's start with the board education workshop. And the topics today is investment risk and return. So this will be our very first.
Before we move on, we did just get a request to speak on item 7A. Mr. Darby? Microphone will be turned on for you. Please identify yourself for the record, and you'll have up to 3 minutes for your comments.
Mr. Chair, board members, good morning. Al Darby, President, Retired Public Employees Association. Regarding co-investing, when there was an effort afoot to create 2 independent GPs, I was told that most PE deals were in the $100 to $500 million range, but CalPERS, with its bigger purse, could do the $1 to $3 billion deals in PE that would be potentially enhancing our ability to operate in the PE area. Well, as a co-investor, CalPERS should be able to swing these bigger deals while at the same time being almost invisible to the public, which is what was one of the ambitions of the 2 independent GPs, was to keep CalPERS as the not the open partner, but a silent partner and an invisible partner to these companies that would be targets for PE. Also, these deals, which could be more favorable with co-investing for CalPERS, would retain transparency, accountability, alignment, and direct with enhancing our ROI to CalPERS, and while almost remaining invisible to the general public. Thank you.
Thank you. Mr. Ming?
Thank you, Mr. Chair. As I said, that today we have an esteemed guest, Mr. Jeff Bailey from CFA, to help us with the board education workshop. And as I said again, we'd like to thank Ann Simpson for her input and contribution to this very important project. This is the very first of a series of education workshop, and today's topic is investment risk and return basics. So without further ado, I turn over to our CFA guest.
Thank you very much, Ben, and good morning, board members, and welcome to our new board members. This is a special day because it's the very first of a new series of board education. And if we go to the next slide, thank you. Just to remind the board and to let new board members know, last year CalPERS went through a process of self-evaluation, looking at how the performance of the board could be strengthened, both individual members of the board but also the board as a whole. And the evaluation was facilitated by the National Association of Corporate Directors. And when the findings came forwards in January, the issue of education and developing a curriculum was really at the top of the list of feedback from board members. And our board president, Henry Jones, established a number of work streams. And I'm delighted to say that the work stream being led on education and the development of the curriculum by Teresa Taylor and Mona Pasquill-Rogers is off to a flying start with today's event. So I'm very pleased to be able to, with Ben, welcome Jeff Bailey to speak to us. But I'd also like to acknowledge Amy Boris, who's here from the Council of Institutional Investors. This effort really is teamwork. We have CalPERS, of course, ready to learn and eager to find out more. But we're really fortunate to have CII as well as the CFA Institute as our partners in this project. The next thing I'm going to recap, oh, there we go, the pension buck. That's actually the most important graphic on anybody's day job around the investment work. Before we start the workshop, I wanted to put this up. It's something many of you will know. It's not like Monopoly money. It's a little CalPERS dollar. And I think what's so important, it's such a simple image, but what it shows our members is where the money comes from. For every dollar that CalPERS pays out to our almost 2 million members as they retire, and that's over $20 billion a year at the moment, for every dollar, 59 cents comes from the investment returns. This is why I understand Ben has a mighty responsibility as the CIO with the investment team. But if we could go to the next slide, please. But the important thing to remember for today's education is that we're not looking at the role of the staff, the internal managers and the external managers. What we're looking at today is the role of the board. And as was mentioned by Ben and Beth earlier, we have very good evidence to show that good governance has a really positive impact on performance. And we believe that's true for ourselves, that the quality of the governance of CalPERS is really going to make a difference to the organization's ability to fulfill its mission. So what we've got on this slide is just a summary before we start the workshop with Jeff, just to remind everyone what is the role of the investment committee. It's very different from the staff. And the board has 4 areas of responsibility, and you can read them all in glorious detail in the full delegation. That's a public document. And the first responsibility of the investment committee, which is given its authority by the board, which delegates to the investment committee, is to set the investment beliefs. Now, these have been referred to a couple of times already this morning. They really set out our thinking about where risk resides, what causes the creation of long-term value, and so forth. The committee also sets the total fund and the asset class benchmarks. And Jeff this morning will be talking a little bit about how do you construct a benchmark? What is that and where does it come from? The committee also sets the investment risk appetite. That's also been touched on today. And the criteria and the triggers for information, and with a flow of information that you need in order to play your role as a committee of the board. The committee also has important responsibilities where you will approve activity undertaken by the investment office. You will approve investment policies, asset class strategic plans, and also litigation where there's a material sum involved. We go, but I'm not finished. Unfortunately, there's another slide, just to realize what an important job the investment committee has. We go to the next slide, please. Thank you. Back again to slide 5. In addition, this committee has responsibilities to conduct strategic asset allocation, and also selection, and of course review the performance of board consultants. And finally, very important for any board committee and the board itself is oversight. And we've listed out the key areas of oversight this committee has: performance, liquidity management, oversight of the selection and performance of partners, managers and consultants, also cost effectiveness, risk assessment and the control environment, environmental, social and governance matters, and overall management of risks. Now, this isn't the doing of, this is the oversight of what the staff are doing. So with that brief recap on what the role of the investment committee is, and ever with that CalPERS pension buck at the back of our mind, thinking about where does that 59 cents come from, let me turn over to Jeff Bailey. You do have his biography in the meeting materials. You could go to the next slide, please. Thank you. There's 2 things I want to flag about Jeff's background. First of all, that he's a trustee. So he's very much in your world. He's not some financial wizard sitting in a back room, although I'm sure you have done that from time to time. But Jeff actually is a trustee, and I think therefore he's coming to the investment role that you have very much as a peer, as somebody who understands the responsibilities that are involved. He's also on the board of the CFA Institute Research Foundation. Now, why does that matter? Well, CFA stands for Chartered Financial Analyst, and this is the standard setting and professional training body worldwide for the financial industry. So obviously Jeff has been a student, that's why he can put the letters CFA after his name, but also he's sitting on the Research Foundation, which is looking at all of the education and training for financial professionals, and several 100,000 of them in many, many countries. So with that now, and our special thanks really for coming out at what was not a convenient time on Family Matters. We're looking forward very much to Jeff's presentation. Thanks, Jeff.
Thanks, Ann. Thanks, members of the board. Let me perhaps just give you a little bit of background on myself very quickly. I actually started out at the Minnesota State Board of Investment out of grad school. And over the years, I rose through the ranks and became the assistant director of the organization for 5 years. And I moved then to a consulting firm down in Chicago, where I did a lot of work with large pension funds on performance analytics. But being a Minnesotan, I got homesick and I wanted to head back to Minnesota. And I took a job at Target Corporation as the chief investment officer there. And among other duties, I was responsible for the investment of our pension fund and our 401k plan. And spent 2 decades there at Target. And I actually retired from Target about 1.5 years ago. Over that time, while I was in those roles, I also spent a fair amount of time still at the Minnesota State Board of Investment, just knowing you always come home. And I was the chair of the Investment Advisory Council for many years, and I left that role when I retired from Target. I continue as a trustee of the University of Minnesota Foundation Investment Advisors. As Ann noted, I'm also on the board of trustees at the Research Foundation at CFA Institute. And just to keep myself busy, I'm a finance lecturer at the University of Minnesota now. And so I've continued on in this business because I really love it. And I love being on the trustee side. And so it's important to me to be able to try to work with groups, this one included, to try to enhance the whole idea of trustee education, because it's a hard job. And I want to spend a little bit of time talking about that as we move along here. And my agenda is lengthy. I'll put it that way. We're going to cover a fair amount of ground, but this is meant to be basics. So different members of this group are in different places, I'm quite certain, in terms of your knowledge of investments. And that's fine. And I'm going to get to a moment here where I'm going to say it actually doesn't matter how deep your investment knowledge is to be a good trustee. But our focus is going to be on basics. So, you know, if there's some areas where you say, I get that, fine, relax, and we'll continue on. I'll bet we catch up with something that you're not completely familiar with. But for those of you that are really new trustees, this is a great opportunity to just try to take it in. This is a workshop. Normally when I would do a workshop, I'd have my jacket off, I'd be walking around in front of you, and we'd be very intermingled here. This is a little bit more formal setting than I'm used to in those sort of situations, but I still urge you to sit back and relax. This is education. There are no decisions to be made, no conclusions to draw. This is an opportunity to ask some questions, to absorb some knowledge, and hopefully get comfortable with the idea of your role as a trustee. So, I believe you were sent this book. This was something that I wrote with a couple of co-authors back in 2011, and it got popular enough where we ended up doing a second edition of it. It's called A Primer for Investment Trustees. Primer, is that right?
I say primer,
yeah,
you say
okay.
tomato.
Okay, yeah, right.
So,
A primer for investment
primer,
trustees. I go to the source of true English language, so I'll say primer for investment trustees. But it's something that I've firmly believed in over time, is that this sort of approach of trying to educate new trustees in numerous situations is not easy, because trustees come onto boards in all sorts of situations. Quite often they're very unconfident about their roles, and the ability to ask questions and the ability to grasp some of the important concepts is troublesome. And so this book was actually written with the idea of being presented to a new trustee. It's written in sort of a conversational tone, by which essentially a staff member is doing a get-to-know-you session, a long get-to-know-you session with a new trustee, and trying to explain some of the key concepts that individual is going to be facing when they're on the board. And the idea is to essentially introduce those concepts in a way that allows the board member to engage in more effective participation in fund governance and setting investment policy. It's the organization of it is designed to capture some of those key concepts, to develop chapter takeaways, But I actually view the most important thing as the questions there at the end of each of the chapters. And if you get a chance to read through that, I hope you take in some of those questions and you think about it, how you might formulate it for your particular circumstances. Every trustee meeting usually involves some knowledge transfer about which you really actually don't know that much about. I mean, that would just be pretty natural when you're a trustee. You're being inundated with material from a professional staff, quite likely, that understands it much better than you do. And the ability to ask effective questions, I think, is at the heart of being able to be a good trustee. So if you get a chance to look through the primer for investment trustees, I urge you to do so. I'll emphasize this is a product of the Research Foundation, and there are no royalties attached to it. I get paid nothing from it. The Research Foundation is a nonprofit organization, and all our materials in the public domain. So it's yours to pass around as you see fit. Let me talk a little bit about the intended audience of this, investment trustees. And again, I'm trying to be very basic here. I think you understand your role, but I think it's important to spend a little bit of time just thinking about trustees as a general concept. There's an organization called the Greenwich Roundtable. It's out on the East Coast, and they do a lot of work in research and investor education. And they wrote a report a number of years ago that essentially said, this just blew my mind, that essentially there were over 100,000 asset pools in this country with long-term investment objectives, and something like 10 years or more is the way they estimated it. And they said that there were something to the effect of 500,000 people on the governing boards of these organizations. I mean, 500,000 people were involved in this. And another 500,000 were on various investment advisory groups. In other words, they may not be the fiduciaries for those pools of money, but they were advising. So now there's probably some overlap in that and so forth, but let's just take the number 500,000. That's an amazing number of people that are involved. And I know when you work in your own setting, you get kind of blinders on. You look just straight ahead and you see your problems. But the problems of these other organizations, this could be a small church fund that's collecting money to build a new building or something like that. It's one of the number of the number of pools that are out there and the number of individuals that are responsible for this is quite amazing. I'm sorry. Oh, I've got a question here. Yes. Yes, and I'm going to get to that, Ben, in just a second. No, that's quite all right. Now, I've worked with groups, these various, with pools of long-term investment capital in a lot of different roles. I've been the staff, I've been a consultant, I've been a trustee, I've been in advisory councils, and I guarantee you I understand how difficult those particular roles are. And the questions that are going to come up are really the ones that I would like to take some time to address today. Now, the question that was popping up here and what I intend to do is at various points along the way, I would love this to be an opportunity for you folks to jump in and ask some questions. And I'm going to try to pause at various points in time and open it up. Again, I realize this is a relatively formal setting, but if you just listen to me for an hour and a half or so, this is not going to be a terribly interesting discussion. It's going to be a lot better if you're willing to engage with me and ask some questions. Now, I'm going to bounce it right back. Many of the questions that I'm going to pose, I don't have an answer to. I mean, they're your job and the job of you engaging with your staffs to come to those conclusions because they're specific to your organizations. But the questions that I'm going to pose are actually those that I think that all organizations ought to take a position on as they develop their investment programs. So again, please feel free as we go along here to interrupt. Like I said, I'll try to pause at various points in time, but don't just let me just plow through this material, please. It'll be a lot more fun if we do it that way. Questions at this point?
You've already sparked some. Ms. Yee.
Thank you, Mr. Chairman. Thank you. I'm actually very excited about the session this morning. You know, in reviewing the materials for this session and looking at, I guess, just the structure of the agenda today, I was a little surprised. Anne had opened up with just kind of the committee's main oversight roles in terms of reviewing investment performance and cost effectiveness, risk assessment, and I mentioned this to Marcy last week, but it surprised me in terms of the missing elements of the investment committee agenda for this meeting in terms of some of those oversight elements. And so just making an observation, and I think it really speaks to, how much information do we need to really fulfill our responsibility. So I'm just going to put that out there. No need for an answer now, but it was just kind of startling to kind of see in preparation for this and then not have kind of the usual elements that we see in the investment committee agenda with us today. Okay.
All right. Well, let me continue then with
we have one more.
I'm
Mr.
sorry. Go
Jones?
ahead.
Yeah, thank you, Mr. Chair. Yeah, you sat through the previous agenda item on private equity discussion. And as you go through, there were some questions that in my mind may have been not an oversight issue, but a transactional type question. I would like you to comment on those two elements as you go through today, to shed some light on those roles.
Completely fair, and I will. Most definitely. Let me say one other thing as a form of introduction, and then we'll move on into some of the meat of the discussion here today. As I said here, and maybe Mr. Jones, this may go a little bit to your point. Who is an investment trustee? Well, I say it's anyone who's charged with high-level supervision of investment assets, and the adjective high level is I think a very important term there. You don't have day-to-day responsibilities for managing the assets. And the focus, as I say, is really on picking the top leadership, making sure that element of governance is in place, setting the appropriate investment policy, and monitoring performance relative to objectives. I think the key is that to do that, you don't necessarily need extensive investment experience. It certainly doesn't hurt, although I actually have seen some trustee boards where too many investment professionals on the board actually disrupt things quite a bit because everybody has their own particular opinion about how the world ought to work. And that then they lose sight of the high-level supervision of investment assets that's supposed to take place. I'm constantly reminding people that in Minnesota, we actually had an actor bodybuilder as a governor, I think, before you did. And in that setting, that individual was the chair of the Minnesota State Board of Investment. And while I was not associated with the Minnesota State Board of Investment at that time in my career, I had a lot of friends that were there, and they said that he was actually quite effective, that he was a good listener, that he didn't step into situations where he didn't have the competence to do so, and he let the staff do their jobs when they were supposed to do their jobs. So no one would claim that this gentleman was an investment expert, but most of the people, again, I've talked to thought he did a very good job. So the whole notion that you have to be an investment professional, I think, is to do a good job on this, I think, is misguided. But you do have to have some knowledge of investment basics, and that's really what we're here for. And that's really what the investment, the primer for investment trustees is all about, is to be able to provide some of that basic education. And we're hoping to fill the gap that we have for individuals that are trying to develop that, because so many of the books and education materials that you see today just are really associated with very strict and limited discussions of fiduciary duty. You can find investment textbooks all you want, but there's actually very little education that goes on for training investment trustees, and the primer is meant to fill that gap. So, questions? Okay. All right. Well, the primer itself has nine separate areas, and we're going to focus on two, really. Investment risk tolerance, we call that's the chapter title. I'm going to refer to as investment risk as we go along here, and investment assets. And as we move through this, you'll see a number of different slides. Well, I have questions on the right. Ann warned me that you've been given a list of questions that you might be interested in asking at some point. And I'll say that it'd be a great opportunity to jump into some of those if you have that list. Again, I'll probably push back and say I don't necessarily have the answers to those. That those are discussion items, but it'd be great to throw some of those out on the table and get a little bit of your sense of what's appropriate. So let's start with the idea of asset classes here. And as I said in the beginning, I have a simple premise that trustees don't and shouldn't deal with individual investments. That's not your job. And if you're doing that, then you're really moved into an area of trustee work that you don't belong in, to be quite honest. Your key role is setting investment policy, and one of the ways that you set investment policy is to establish a policy asset mix. And most organizations do that by identifying a combination of asset classes that they believe expresses the appropriate level of risk for their investment program. And an asset class is really just a collection of individual investments that behave similarly in important ways. And also the asset class the assets that are in the asset class tend to behave differently than assets that are in another asset class. I mean, that sounds a bit circular, but it's actually a fair statement. There's no specific definition of what is an appropriate asset class. You could probably say that I'm going to split the world up into equities and bonds and walk away, and you would be pretty close to doing your job as an investment group of investment trustees. Now, most assets are more nuanced than that, and it pays to get a little more granular, but it's also the case that equities and bonds are a very high-level description of what most investments that you could engage in. They capture the fundamental elements of that. This slide shows a potential division of assets into different publicly traded types of assets and private market assets. I want to emphasize this is not exhaustive. It's not necessarily the way you want to do it. It's just a sample. But each one of those asset classes, in a sense, is a shorthand. I mean, that's how I view asset classes. If you went to an investment professional and you said, we're 70-30, 70 stocks, 30 bonds, that investment professional would understand what you're trying to say at that moment. I mean, you don't have to actually say a lot more than that at that moment. Why? Because the investment professional reads the shorthand. The investment professional understands what's behind equities, what's behind bonds, what you're trying to say when you say you're 70-30. If you said, well, my 70 or my 30 maybe is composed of 20% government bonds and 10% high yield bonds, now I've split my bond side into additional asset classes. And again, the investment professional would read that shorthand and understand what you're saying about the government bonds and what you're saying about the high yield bonds. So asset classes are just a way to express, in my mind, some of the fundamental characteristics of the underlying investments that you might participate in. If you have 1,000 investments, you could have 1,000 asset classes. I mean, that wouldn't make much sense, but you could do it that way. As you start to aggregate, you start to tell stories about the individual investments in groups, and that's helpful. That's what you start to create that shorthand. And your goal ultimately when you create a policy portfolio is to create the most efficient combination of, from a risk and return standpoint, most efficient combination of investments that you possibly can. And the shorthand that you use with asset classes is just one way to try to get at that expression of your investment policy. So there's nothing magic about asset classes. You decide for yourself what is the appropriate granular level. Understanding you get too granular, and then the investment professionals start to lose track of the shorthand. Exactly what do you mean by that particular investment? You get too aggregated and you maybe lose some of those key nuances that go on in those particular asset classes. So there's a middle ground there, and different organizations take it differently. I mean, some organizations take publicly traded equities and they split it up between U.S. and the rest of the world. Other organizations want to just have a global. I mean, there's no right or wrong answer to that. So I've noticed how I've split that into a publicly traded side and a private market side, or oftentimes called alternative investments. Institutional investors, there's a tendency to do that, and different organizations treat this differently. On the left side, the publicly traded side, I mean, we know a lot about those asset classes, however we slice them up. So we have great data on U.S. equities. We have timely, frequently calculated, clean, comprehensive data. There's no doubt about that. We can build benchmarks for that data. We can develop correlations, understanding how these assets tend to move relative to each other. And we know that the market for those publicly traded asset classes is quite efficient, that the price of the asset is probably very near the true investment value of those assets. All right. I mean, that's just standard stuff. Private markets, there it's a little bit the other side of the coin. You know, we don't have great data on private markets. It's not necessarily timely. It's not necessarily frequent. Oftentimes it's very dirty in the sense of it's just hard to separate the noise out in the valuations. We don't have great benchmarks for that sort of data. And we are kind of sketchy on the correlations, how these assets tend to move relative to one another. So I think that's the reason that I and most institutional investors tend to split out publicly traded from private markets, is a lot of the information that's available on the public markets is very different than the information that's available on the private market side. Now, I'm not going to get deep into alternative investments.
Before you go forward, we do have a few requests.
Please.
First of all, when you refer to asset class,
Yes.
is that the only lens by which to review a fund?
Well, yes, I think that's a great question. Not yes as in that's the only way. I think there are different ways to view it. Go back to my statement about the shorthand. So you could think of asset classes as being sort of bundles of what I would call exposures to economic events. So when you think about equities, you could think about equities as being exposure to the U.S. economy. You could think about it as being exposure to corporate profits. Okay? So I could actually kind of build a model that didn't talk about equities, it talked about those exposures to the economy. It's called factors. I mean, there are ways to build asset investment policies that are just based on factors. Think about bonds for a minute. I mean, bonds have an exposure to nominal interest rates. When the Fed raises interest rates, bond prices tend to go down. Bonds have an exposure to inflation. So I could build an investment policy based on some of those exposures. Again, I think... I'm sorry.
Yeah. If I may, so when Jeff's talking about the factors, you're very familiar, we used risk segments. So that work that's under your leadership in the past couple of years, the risk segment work is the Jeff is talking about the risk factors. So to your question, there perhaps another way further to align the different asset classes by risk segment, let it be we call growth or income. So we can also look at the portfolios through a lens of risk segments or factors.
Right. Yep.
Thank you.
No, that's a very good point. So, Mr. Fechner, when you ask that question, the answer is clearly yes. That's a long-winded yes, but it's clearly yes. I think what happens, though, is that most organizations have a difficult time with that alternative form of shorthand. So I could talk about an economic exposure in my portfolio, but trustees and even staffs have a tough time manipulating that. Ultimately, I have to invest in something. So I can't invest in economic factors. I can invest in stocks. So I mean, that's the other reason why you tend to see that expressed that way.
Yeah, and for those of you who were on the board when I was here the first time, you probably still remember my soup analogy. So that's the soup is the factors. Thank you.
Yes, and you didn't bring soup either. So.
Next time.
Yeah, Mr. Perez.
That's right. It sort of gets
Mr.
to be
Bailey,
kind of a goulash.
I was intending to go ask a question when you went over it, but we didn't talk about it.
No, please.
Under Rules, Section 1, and this is the PDF of your book.
Sure.
I didn't get this. I got the PDF. Under Roles and Responsibilities, page 13 of the PDF, the board, it says the CIO. Now, I understand this is the your version of best practice, or in the perfect world, the CIO reports directly to the board on an annual basis, and then we discuss and determine compensation for the following year. And then it also says that we approve the CIO's selection of senior staff members and sign off on his or her evaluation of those staff members. This leadership team is critical to effectively translating your vision of investment policy into a concrete investment program. That's not how we do it here. And can you speak on the benefits and the risks of the way that CalPERS does that, please?
Well, and I want to be a little careful about speaking on the benefits and risks of a specific organization. Different organizations treat this treat this in a different ways, and there's nothing. I think it's really the question of micromanaging, right? I mean, whenever a trustee group gets too deep into the decision making, I think you run the risk of micromanagement. And it could be that it's quite reasonable to say that an organization is going to appoint one individual and deal directly with that individual, and then that individual is delegated the responsibility to make all the decisions below that. That makes complete sense. I think the description that you're taking in there, that you took from that page 13, is an alternative view, but it isn't going much deeper. It's completely reasonable also to say that a trustee board might have some say over the senior managers that are one step below the CEO or the CIO of the organization. I think it's more a question of a slippery slope. Once you start getting too far down into the decision making of personnel, then you run the risk of essentially freezing the power of the leader of that organization. So it's completely fair, and I would point out everything that goes on in this particular book is just one stylized organization. I would read it in a nuanced way that we're not saying that that's the only way that a board can operate.
Marcy?
Yeah, Mr. Perez. So currently under the CEO delegation, you've delegated that to me. But one of the process pieces that I put in place is when we hired the CIO, when we hired the CFO, I invite board members in to participate on those panels. So you are involved in the selection of some of the senior management positions here in the organization by the fact that you're sitting on these interview panels, giving input and giving whether you think that those are individuals who could come before this body and be successful.
Anything else, Mr. Perez?
No, sir.
All right, thank you. Mr. Jones?
Yeah, I was back to...
Hold on. All right, just a second. There you go. Oh.
Okay, thank you. Thank you, Mr. Chair. Back to your slide 12, 12 of 55. Looking at the asset classes, and then you made reference to the benchmark. So the benchmarks allow the board oversight to determine, to assess success. Mm-hmm. So, but if you go down to breaking out these asset classes to several subclasses, then you also mentioned that it becomes difficult to have a benchmark for those items. So how do you create these subclasses if you can't evaluate success by using a benchmark?
Well, Mr. Jones, let me get to the notion of benchmarks here in just a second. Okay. I mean, I'm really a slide or two away from dealing with that very important question, and I think let me come back then to your question at that point.
Ms. Taylor.
Thank you, Mr. Chair. So, hold on. Let me open my book back up to my question. So and actually, now that I look at my question and heard your answer to Mr. Jones, maybe we might want to wait. But I was at your class. First of all, I want to thank you for being here.
Okay, sure.
And I was at your class at the CII Institute, and I want to kind of go into something I remember that you said, which was that the private equity and public equity markets are not dissimilar in that they're They're kind of the same thing. So we're not getting into a different investment when we get into private equity. But in that, we don't have a real easy time benchmarking that.
It's true.
And I think you're going to get to that.
I am.
Okay.
Yes, absolutely.
All right.
I think it's a very important question.
Ms. Brown.
Thank you. My question is not about benchmarking, and actually piggybacks on Mr. Perez's comments. We did not compare notes, but I actually highlighted page 13 and dog-eared that page about the CIO reporting directly to this board. And the CIO used to report directly to the board. They used to have come to the board in the selection, and I believe some other key members it did as well. And we didn't back off because of micromanagement issues. It was more because of there was a report done by Steptoe and some other reports after a bribery scandal and a suicide, and the board sort of changed its oversight model. But I have concerns that the CIO doesn't report directly to the board, because I can't get I can get answers to the CIO, and it's got to go through the CEO, and a memo has to be pre-approved. So there are issues with our organization, and I know that's not the point of this training, but I think it is very important for us to look at. If we want our CIO to have the best returns and do the best for us, I think the CIO should report directly to the board. My other concern is just overall, you talk about micromanagement, but what you really don't talk about at all in this book is the opposite, is when the board actually becomes a rubber stamp. And so I hope eventually we'll get to that. You've been a staff member a very long time, and so you would, of course, come to it from a board meddling point of view. But there also is another problem, which is on the other end, when the board just does exactly what the staff says and hasn't had the training or the expertise. So I really appreciate this training. It is about time. Thank you.
Well, thanks, Ms. Brown. And I do spend most of my time now as a trustee, not a staff member. So I completely understand that. And I would point out one item, too, on the primer, is that we have a chief investment officer in this stylized organization. It's not meant to be so big an organization as you run here, where you need a CEO and a CIO. So, I mean, again, my point simply is there are differences in how organizations work, and each organization has to identify the appropriate lines of authority that work best for them, with the underlying principles that don't want a rubber stamp body at the top, and you don't want a group of trustees that are becoming involved in day-to-day activities. So there's a fine line.
No other questions? Feel free.
Okay. Let me move ahead to talk a little bit about market indices just for a moment here. A market index, as I say here, is just a basket of securities that's designed to represent the performance of an asset class. And you're familiar with sort of the standard ones, the Dow, the S&P 500. Knowing exactly how they're constructed and so forth isn't as important as understanding what they're attempting to do. I think people lose sight of the fact that there are literally thousands of market indices out there. You can take your asset classes and slice them up and do an incredibly broad number of subclasses, and different organizations produce various market indices. Some of them very much overlapped, but you can go out and find in any large investment banking firm, you can find them producing market indices. You find organizations that do this for a living. So they're out there. I always say that when you think about a market index, there's really three things you should think about. One is purpose, second is security selection, and third is security weighting. So why do we have this index? What's it attempting to do? It may seem simple in the case of the S&P 500. It summarizes the performance of the market. There are a lot of smaller, more finely cut indices that are designed to capture specific investment styles. With the rise of exchange-traded funds, we've seen all sorts of market indices pop up just as essentially a tracking target for these exchange-traded funds. And so understanding why the index exists, I think, is important. Security selection. You know, you have broad inclusion, which would be something like the Wilshire 5000, which is technically every publicly traded equity security in the United States within certain rules. Or you have the Dow Jones Industrial Average, which is 30 stocks these days. When it started out, it was 12 back in the late 1800s. Security weighting is the other key issue. Most weighting schemes that are involved in building a market index are what referred to as value or capitalization weighted. Each security inside the index gets an importance equal to its market value, the number of units of the security times the price per unit. But you do have there are different ways of weighting things. I'm not going to go into some of those secondary forms, but it's important to understand that they do exist. I think what I really want to concentrate on is some of the uses of market indices. The standard use, of course, is just to explain the market environment. When somebody says that the Dow or the S&P 500 today is down 2% plus, something like that, you immediately know that the stock market is performing poorly today. I mean, that's again a shorthand. You don't need to say anything more. But what you find is that when market indices were originally created, they were used primarily for that. But in recent years, we've used them for performance benchmarks and passive management strategies, which is why I think you see so many of them today. Because we do want to find ways to evaluate investment programs, and we do want to implement particular strategies in the marketplace, and we need some sort of benchmark for those strategies. So I think the prevalence of market indices today is really associated with those last two items.
Mr. Rubalcaba.
Thank you. You know, I've always been intrigued by this whole thing of active versus passive management, and a lot of people always ask me, you know, especially when there's the fund perform below expectations, the intermediate benchmark, and say, well, don't just invest in the index. So can you speak to that issue?
Can I come back to that a little bit later? I think it's a great point. We're going to spend some time on the whole idea of active passive, and we're going to transition right now into investment benchmarks and some of the characteristics of benchmarks that would allow you to do exactly or think about the problem in exactly the way you just described it.
Thank you.
So I think it's a great question. Let me just get to that here in just a second.
Right ahead.
Okay. Well, like I said, let me move from market indexes to investment benchmarks. They are not one and the same, and I think that's important to understand. This is kind of a nerdy term here, but I'll say a benchmark is a passive representation of an investment process. I like to think of it as the fishing hole. So if you're saying, I'm going to carry out an investment program, where am I going fishing? And depending on your answer to the question, you're going to evaluate your program differently and build a benchmark differently than someone else who has a different fishing hole. This idea of persistent and prominent characteristics of the process in the absence of investment management. This is exactly what we were just talking about a moment ago. This idea of passive management, what would I envision would be the characteristics of a portfolio if I didn't have any knowledge about what was going to outperform? So the idea is I need to just be able to describe what this passive portfolio looks like. And I say investment process because it might not just be an investment manager. It could be bigger parts of an investment program. But it's maybe easier to think about for a moment just in terms of an investment manager. So if I told you that I had a small cap growth manager, and there's a bit of a shorthand going on there, you kind of get some impression of what that might be. Somehow it's investing in smaller company stocks that are expected to, earnings are expected to grow rapidly over time, or at least above average over time. We have a sense of that. And the idea of a benchmark is to try to quantify that. So can we build something that I could actually own that would capture those persistent and prominent characteristics of a small cap growth manager. And so when I think about an investment benchmark, I want to build that fishing hole that's associated with that investment process. So it's a great concept, not necessarily so easy to do all the time. I'm going to get to that in just a minute. Let me talk about functions, though, because I mean these are really pretty critical. I list 4. You might think of a few more, but I think where we most commonly think about benchmarks is we use them in performance evaluation. So trustee boards feel an obligation, and appropriately so, to say, is our investment program performing well? Well relative to what? Well, relative to an appropriately designed benchmark, and that's where the performance evaluation issue comes in. You have to have confidence in the benchmarks that you're working with before it makes sense to pass some sort of judgment on the effectiveness of the program. Policy asset allocation. This again goes back to this sort of shorthand, but I need something that is going to reflect the various types of asset classes that I might invest in, so then I can build a portfolio of those asset classes. And again, if I wanted to be very high level, I'd say stocks and bonds. Maybe I'd have some global benchmark for stocks and some global benchmark for bonds. If I want to be more nuanced, I'll start to split it up. But I want to build a benchmark that's investable in each of those particular asset classes or subclasses that I can use to express my policy asset allocations. Very closely related to that is the whole idea of risk control. If I've built an appropriate benchmark, I should be able to start to manipulate it in a risk control manner. I should be able to put them together to simulate the outcomes that might occur, to look in the past and see how that combination of benchmarks, what it did for me. I should get an idea of how risky my portfolio is based on looking at that combination of benchmarks. So it's a critical element in your whole risk budgeting program. And lastly, performance fee calculations. I mean, if you're going to pay somebody based on their performance, you ought to have confidence you're paying for them based on their performance relative to an appropriate benchmark. So all 4 of those, I think, are very critical. And we can apply them at the individual manager level, the asset class level, and the total fund. And I'm quite confident that your staff takes that whole process to heart and wants to have appropriate benchmarks assigned to each of the elements of their investment program that you work with. But let me talk a little bit more, though, about benchmarks in the sense of what is a valid benchmark. And these are 5 characteristics of a benchmark that I've espoused for decades. My old firm, Richards & Tierney, did that. It's part of the CFA curriculum. And these are actually difficult characteristics to hit for benchmarks. And let me go through them very briefly, but they're important to understand. Unambiguous. So you should be able to clearly define the benchmark. I mean, it may seem just obvious, but what is involved in that particular benchmark? What are the components of the benchmark? You should be able to identify those. It shouldn't just be some sort of statement of, well, perform well relative to good performance. I can say my benchmark is made up of the following 500 securities in case of the S&P 500. I know exactly what it is. It should be investable. You have to be able to own that benchmark. I mean, without that passive, Mr. Rubalcaba, I think that's where you were going on that. You have to be able to own that particular benchmark. That has to be an option for you. Otherwise, it really isn't a measure that you can compare the performance of your active program against, because you never had the option to own the passive piece of it. You have to be able to measure it on a reasonably frequent basis. It has to be appropriate. That can be interpreted in a number of different ways. I like to say that it has the same level of risk, however you want to define risk for that particular investment process, but it should have the similar level of risk. And finally, very importantly, it should be specified in advance. And you should know what its composition is prior to the start of the evaluation period. Let me pause for a moment. Are there questions on those characteristics? Because those are really pretty critical.
One question, Mr. Miller?
Yeah, I have kind of 2 questions, but Generally, could you speak a little bit about how, in terms of constructing benchmarks, how uniform are the approaches, or are there standards or rules for constructing them? And then, the utility or necessity or challenge of benchmarks for use with private assets.
Mm-hmm. Sure. No, two good questions. I would go at it from the standpoint of there are a number of different ways to construct a benchmark, and actually I've given some examples over on the other side of this slide. To the extent that those methods of constructing benchmarks produce benchmarks that satisfy those 5 criteria, I'm quite comfortable with the benchmarks. So proving that they satisfy those criteria are a little bit is more difficult, and that's where you get into the question of private markets. That can become a problem. The examples that I show there, you can sort of think about how they might apply to private markets. Absolute T-bills plus 3%. I mean, you'd be surprised how often that shows up, especially when you're evaluating hedge fund managers. They'll come up with something similar to that. They'll add some premium onto a T-bill rate and say, well, that's our benchmark. Just judge us whether we've outperformed that or not. I'm going to argue that that is not investable. I don't know of any particular investment alternative that I have available to me that is T-bills plus 3. It's may or may not be appropriate. I don't know. I mean, I have to understand how the manager actually operates, but quite likely it doesn't have the same amount of risk that that particular hedge fund manager takes on. So, I mean, there are some pretty severe problems there. Manager universes are one that has always been a big challenge from my point of view for most trustees. It's quite common to compare yourself against other organizations, and that's problematic for several reasons. First of all, it's not investable. You can't own the median of a peer universe. It's not specified in advance. I don't know who that organization is at the start of the evaluation period. That organization may not have similar risks. It's oftentimes unambiguous. It's oftentimes ambiguous in the sense of the universe that I'm dealing with may not be well specified in terms of who are the components of it. So manager universes are a really serious problem when it comes to building benchmarks. And I know the horse race game is what most trustees get sucked into. And I understand that, and I know the temptation. But I think you should sit back and challenge it as a trustee about whether that's appropriate or not. You move down to market indices. Oftentimes the S&P 500 uses a benchmark, and it may well be for a broad equity manager. We talked about the example of a small cap growth manager. That would seem to me to be pretty obvious that that's not appropriate, not the same level of risk that's going on. Then we start to get into style indices. You know, these are slicing the market in different ways. Maybe we can design something by that slicing that gets us closer to the risk of the particular portfolio that we're trying to evaluate. And there are returns-based benchmarks, which are combinations of style indices. Those are pretty interesting. And lastly, you can build custom security-based benchmarks, which literally involve interviews with managers and saying, well, what is your fishing hole? Let's identify that. Let me pause for just a moment, because I think Ben is going to say something here.
Thank you. If I may to add something to Mr. Miller's question, your observation, you're absolutely right that one of the challenges we face is the benchmark for private asset classes. For example, in our private equity benchmark, it's public equity plus a spread, and it's plus 150. So if you look at on slide 16 on the left, what are the characteristics of a valid benchmark? And look at investable. The second on the left is investable. So just to follow on what Mr. Billy just said, the public equity plus 150 as a benchmark for private equity is not investable for our need, our scale, right? And then the other one you can also challenge, is it appropriate? Does public equity and private equity have similar risk or not? So that's a light surface issue, but still it's not perfect. So that highlights the challenge we face in private asset classes to have a benchmark. And what can benchmark do in private asset classes? We had to be very mindful. And then on the right, the benchmark, the very first one, absolute, the T-bill plus 3%. Again, as Mr. Billy said, that is not deliverable or investable or guaranteed. But on that note, if I may just extend it a little bit, something we may want to consider future down the road. Currently, we run our portfolio with a benchmark relative, each asset class relative to a benchmark. For example, public equity is relative to a combination for a public equity benchmark. And each asset class, fixed income is relative to a fixed income benchmark. But if we think about our goal is really in the long term to deliver the 7% rate of return, would that make sense or as an alternative to set the 7% as an absolute benchmark for the fund? And that may be better aligned with our long-term goal. Just something for the body and all of us to think about. Should we be a relative benchmark to an asset class, or should we be benchmarked to our long-term goal, which is to deliver the 7% return?
And I understand where Ben is coming from on that. A lot of organizations do have that as a target. I think it does run into the investable notion. I don't know of anything out there that I can guarantee 7% from. So I have to have an alternative that I could invest in that would deliver 7% if I was going to go that route.
And if you did, I would be so happy to transfer my seat to you. Exactly.
and I think that's, to me, that's one of the dilemmas that public funds face today, is that the expected returns on their portfolios actually derive from a bygone era when interest rates were higher, and there were options to hold something that delivered almost 7% back in as late as the late 1990s. You could do that. And so today, the public pension funds have been, in a sense, almost marooned on an island because the water level has fallen, and yet the expected rates of return haven't fallen anywhere near as rapidly. And so the ability to create an investment alternative that just forgoes active management and says, I'm going to hold this passively and produce that result isn't there.
Anything else, Mr. Miller? Mr. Jones.
Yeah, thank you, Mr. Bailey. The investable benchmark, again, I was going to ask you, but I'm going to now defer to Mr. Mang, because he indicated that he's going to be looking at some of these benchmark categories, because we have a number of asset classes that are using some index plus a given measure amount, infrastructure, private equity, real estate. So I'm glad to hear, Mr. Mang, you're going to be looking at see if there's a better way to use some kind of investable benchmark going forward.
Yes, so together with the senior team and the investment office, we are conducting a very comprehensive review of all the benchmarks and how to align with our long-term goal.
Ms. Ortega?
Yeah, thank you. I'm not quite sure how to ask this question, but it seems to me that so much of the benchmark conversation with pension boards is around performance. And so you're looking at it, and in terms of compensation as well. And so what I find really difficult is a lot of times when a proposal comes forward to change the benchmark, it seems to be aligned with some long-term underperformance against a benchmark. And then the discussion is about how the benchmark doesn't really reflect where the investments were made. And then it becomes hard to it becomes hard to evaluate that from a board member perspective because you're tying it to a compensation outcome. And so kind of related to the issue, as you raised it, Mr. Mang, about looking at total fund performance and other ways of thinking about it, are there other models of compensation out there as well that maybe don't tie kind of direct performance compensation to the benchmark on particular asset classes? Because I think I'd be interested in thinking about benchmarks more broadly in terms of that as well.
Right. You're absolutely right, but I would defer the compensation detailed discussion later. I believe that's the next month. But back to your earlier part of your question and part of the discussion this morning, when we have a benchmark, say each asset class has a benchmark, and we one of the functions of a benchmark is performance evaluation. So how well or poorly we have done against that particular benchmark. But the conundrum here is that the question we are considering now, and one of my colleagues, Paul Machaca at MIT for Real Assets, constantly remind us, how do we define our success? We can measure ourselves against a relative benchmark, as what we do now. Say if the benchmark portfolio, knock on wood, say the benchmark is down, say 10%, we only lost 9%. Relative to the benchmark, we beat the benchmark, but we did not help to deliver the 7% return. Then on the other flip side of the case, it could be we delivered the return, say 10%, but the benchmark delivered 11%. So relatively speaking, we underperformed the benchmark, but we achieved our long-term goal. So how do we design, or how do we define success for the investment office? It's very difficult to have it both ways. I have seen, probably Mr. Bailey can opine on it. Some organizations try to design both ways, ask the staff to do, to achieve both goals, to deliver the outperformance relative to a benchmark at short term, as well as deliver the long-term absolute return. And that is very difficult to do. Use one analogy, basically you'll be asked to put your pants on with, sitting down, very difficult to achieve both goals at the same time. But that's the struggle or challenge we face. And we look forward to working with you and the team to find a better solution. In terms of compensation, that ties into, again, as I said, that I believe next month we'll have a compensation discussion. Ideally, we should define the success first, and then have the compensation plan to be aligned with that definition of success. So with that, I will defer either to Marcy or someone who would like to opine on the compensation discussion.
Can I just ask a follow-up question before you answer? I think what would be helpful for me to understand are maybe some best practices about what information, what analysis a board can get that gives us confidence in being able to review what the staff recommendation is. Because I do feel in a prior experience, I feel the boards find themselves in tricky places around this conversation, because you're getting recommendations from a staff, maybe endorsed by a consultant, but how do we know we really have the right information about the benchmark and then how we're evaluating success?
Thank you very much, Ann Simpson. One of the benefits of doing this board governance work in a partnership with the Council of Institutional Investors is this is the broader group of public funds who we can really learn from. And likewise, teaming up with the CFA Institute, looking at how a broad range of private sector boards work. So when we come to do our work stream reports to you next month, we'll be setting out how we'll be doing another form of benchmarking, which is how does CalPERS approach something? How does the CalPERS board approach something? And how do our sister funds in the public sector work, and look at examples from the private sector as well. So that you've got some way as a board of level setting against the experience of other pension funds. So we're looking forward to that work with CFA and with CII. I would also say that the National Association of Corporate Directors, we're about to enter into the second phase of work with them. So that's also going to give us a bigger pool of examples to look at, which we hope is going to be beneficial. Just to put it all in context.
Can I answer any other questions on that?
G.
Thank you, Mr. Chairman. And Ben, thank you. I really appreciate the more comprehensive look at all of our benchmarks, because I do think kind of in this era of where there's a lot of unknown with respect to particularly the private asset classes, and it is a balance in terms of kind of where we set our sight relative to the benchmark, and whether in looking at whether it helps to align with our long-term goals. I just think about kind of how that reverberates in terms of some of the decisions or considerations we need to make going forward. And that is, and the question that rolls in my mind is that does that necessarily then have us poised to look at taking on less excessive risk, down the road? And so I think it's kind of all integrated in that conversation as well. So I look forward to the study coming back and hoping to just really lay the foundation and kind of a set of considerations that we need to make, because it is a departure from how we've traditionally looked at benchmarks.
Yes, thank you. And that, as I said that we started thinking about that question. It will be, relatively speaking, a longer-term project because it touches upon pretty much everything from benchmarking, as you said, compensation, and more importantly, we have been encouraging ourselves among the senior management team at the investment office. How would our portfolio change? Say, if we shift away from the relative to a short-term benchmark to a long-term absolute benchmark, say 7%, how would you restructure your portfolio? And I can think of a few things quite drastic in the portfolio. So this will be a little bit longer term and a much deeper discussion, and we look forward to working with you. If this body has the appetite for us to continue that discussion and continue that research, we'll be very happy to do so.
And just one thing to add is just remember that as part of the ALM process, that we review the benchmarks as part of the process, and then in the mid-cycle, when certainly we know we owe some work on dual class shares and dual voting rights, but then there will be part of that work also on the other benchmarks as well.
Dan, you should explain your acronym. ALM.
ALM is the Asset Liability Management. Apologies, and I know we use too many acronyms. Thank you, Ann. Asset Liability Management process, where we take the assets and the liabilities and figure out how to try to make the assets meet the liabilities.
Thank you. Okay, Mr. Bailey.
All right. I'm going to switch gears just a bit and take a little bit of time to talk about market returns. And the goal of this is really to just give a little bit of context for some of the discussions on risk budgeting as we get a little later in this presentation here. But feel free to jump in at any point and ask some questions about some of this capital market history. But this is, again, just more to provide context than anything else. And this is sort of, as I say, the standard paradigm. Stocks beat bonds and bonds beat cash. And I say they beat them by phenomenal amounts. The ability of stocks to, over even this relatively short period of time from 1970 to the end of 2018, to outperform bonds by 2 percentage points a year, that compounds into amazing amounts of money over time. And if you compare that to a cash return, it's even a greater surplus. So it's the notion that stocks beat bonds is sort of embedded in every investment program, and that's not surprising given these sort of results. But I always say that this is the way that we don't usually spend a lot of time thinking about it, and these are the annual returns on stocks over the period 1926 through 2018. And these really heart-stopping downdrafts that you can see in the performance of the markets is something not to be ignored. As recent as 2009, we were looking at a period where there was an annual return of almost minus 40% 1 year. And any organization that says they're long-term investors has to be willing to put up with that sort of outcome. This is the other, this is the other way I like to look at it, and in some ways I think it's a more valuable way to look at it. These are referred to as drawdowns. So essentially you can think of it as a situation, if you take today and you say, did the stock market go up or go down? Well, let's say it went down. And then I get interested in the market at that point. It went down. Now, how long does it stay down before it comes back to even? I call that a drawdown. And so these are inflation adjusted. So investors ought to care about the inflation factor when they look at their investments. So I'm taking away the inflation rate from the returns. And you can see the rather massive drawdowns that the S&P 500 has experienced. Jeremy Siegel years ago wrote a really great book called Stocks for the Long Term, really an interesting book, and essentially said, look, if you're a long-term investor, how could you not be in stocks? Well, okay, there's a lot of truth to that, but you have to be willing to put up with these periods of time, and the dotted lines are a period from really, I think it was early 2000 or so, maybe it was 2001, starting at that point, that first drawdown there, and it extended all the way out into 2013. So stocks for the long run, it was fun to discuss that in 2012. I'd say you haven't gotten back yet. I mean, it's been 10 years. Most people, 10 years is a lifetime on an investment board. In fact, it might be 2 lifetimes on an investment board. So stocks for the long term, well, even the most long-term investor is possibly not willing to put up with that.
If I may. So as Jeff just said that, yes, stock in the long run, as it showed in the previous slide, outperform cash and bond by a big margin. And Jeff said that to do that, in order to benefit from that, you'll have to be willing to sustain the extended period of drawdown. In addition to willing to, we also have to be able to. So what may happen in the drawdown when we have a liquidity need? Because we do need to pay members' benefit every month. And that's the reason we exist. We are here to serve the members. So we do have a current cash flow need. When the drawdown happens during the extended period of time, are we able to sustain or not? That's another question. One, are we willing to take on the risk and willing to? The other one is, are we able to or not? And on that note, again, we talk about the liquidity project, why it's so important for us to know, to have a very comprehensive liquidity framework and to know where we are and how long we can or will be able to sustain that drawdown in order to benefit from the long-term equity premium.
I couldn't agree more. Investment returns and risk. I think the point I'd like to make here is that investors tend to like to discuss returns. They're very tangible. We earned 8% last year, something along those lines, and you can talk about it in very specific discussions. Risk is in the future, is the way I like to think about it. You have a range of possible investment outcomes, and it's a very intangible idea. It's hard to imagine what risk really means. I mean, you can say we're going to talk about volatility in just a little bit, and then we're going to try to find quantitative measures of it, but it's really hard to imagine exactly what risk is. You experience returns, you try to manage risk is essentially the way I'm arguing here. Most investment committees, you would not be alone if you do it this way. You spend a lot of time in your quarterly reviews. You'll get a rate of return. You might have some sort of benchmark that you believe is appropriate, and you look at it and you see results relative to it. But that's really just looking at the return side of things. And most organizations don't spend a lot of time talking about the risk side of things. And I think trustees really ought to be spending more time on risk and a lot less time on returns. But it's just the nature of the beast that organizations tend to get caught up on the return side.
Ms. Taylor?
Thank you, Mr. Chair. I agree. I think we ought to be looking at risk, and I think part of our asset allocation looks at that. But while I think we manage risk by looking into the future, we sort of do it by looking at the past, right? So we're looking at what happened in the past. And I think as I was reading information on this class and other stuff, when we were looking at risk in the future before 2008, we looked at diversification. It didn't help. So managing, 2008 we crashed. So it didn't necessarily give us a big risk mitigation process. So when we look at data, it's just so hard for us to look at how we manage that risk. Volatility looks at past, we have past, we look into the future for ESG strategies that can down the road pose material risks, whether that's in the environmental, the social, or the governance issues. And we can see those sort of pop up here and there right now, right? So I'm just trying to figure out, how do we manage overall market risk like that? and what are your, sage views on that?
Ms. Taylor, if I could defer that just for a little bit, we're going to try to address that. 2009 was a pretty interesting example for a lot of organizations, and I actually would argue that diversification did work in 2009. It was painful. I mean, you don't get off scot-free in this world. If you're going to have an equity exposure, you're going to take a hit. But I'll bet in 2009 that your diversification programs actually benefited you quite a bit. If be surprised if that isn't the case. Certainly it's true at any investment program that I've witnessed. 2009 actually was a great year for diversification in a lot of ways. But let me get to that in just a minute. To my point, this is a quote from the fabled Benjamin Graham. The essence of investment management entails the management of risk, not the management of returns. And I really, truly believe for trustees that's where your focus ought to be, is on managing risk. These are just some returns that we already saw in that graph, but just to be aware of them. Over an extended period of time, the arithmetic return, we won't get into unless we feel the need to, the difference between arithmetic and geometric return. But let me just say the arithmetic return, the average of all the annual returns for stocks, 11.9%. Versus T-bills of 3.4% is a huge difference. But the volatility, and we're going to talk about what we mean by volatility here in just a second, the volatility of those stock returns at 20% per year versus 3% return for T-bills is significantly different. And we should all be aware of that difference as trustees. The other thing that I mentioned too, and I don't have a great segue out of that, but is that the U.S. stock market there's a lot of selection bias that goes on when we look at those numbers for the U.S. stock market. I mean, we won World War II. There are all sorts of good things have happened in the United States that didn't necessarily happen for some countries. And so if you invested in the Russian stock market before the revolution in 1917 or something like that, your results didn't turn out so well. So the U.S. stock market there's a selection bias that goes on. And I always worry when people look at that 11 or 12% return per year that they start to extrapolate that out, that somehow that has to be what we're going to get in the future. And this was an extremely productive period for U.S. stocks, so the time that we're looking at, and we should all be aware of that. This is worthwhile paying attention to for just a second. Why should stocks beat bonds? And I say, well, because they're riskier, right? Well, but think about what we mean by that, and that this is kind of important when you think about how you want to diversify yourself. Stocks represent ownership in corporations. That's a straightforward statement. Corporate earnings are sensitive to the economy, therefore stocks ought to be sensitive to the economy. And they are, but there's something probably more important about that I think is worthwhile paying attention to. And this goes to Ben's point here just a second ago, is that stocks do bad just at the time you don't want them to do bad. So when you think about a public pension fund, the time when you might have to make additional contributions to the plan because your equity portfolio has performed poorly is just the time the tax revenues are going down and your liquidity situation is stretched. And that's true for an endowment fund as well. Contributions start to dry up for an endowment plan about the time that you have big recessions. A corporation, it's the same thing. Target, when I worked there, our worst period of time to be able to put money in that plan was 2009, but that was a time when we really wanted to put some money into the plan. So stocks do badly at the wrong time, and so they need to do something to make up for that situation, and they have to do better in normal times. I mean, that's a long way to say that's compensated risk. So when you expose yourself to stocks, you expect to get compensated. Why? Well, because you're going to get hurt at the times you don't want to get hurt. And the only reason you'd own stocks is because in those normal times you get paid more than the assets that wouldn't hurt you in those bad times, those bad economic times. So bonds are the opposite side of that coin. Why do bonds earn less than stocks? Well, they're less risky. But why are they less risky? They don't hurt you at those times when you can't afford to be hurt. So it's compensated risk is a key element for investment programs, and I think trustees sometimes lose sight of what's compensated risk and what's not compensated risk. We're going to talk a little bit about active and passive management a little later here. Active risk is not compensated. You hope you're smart and you pick the right folks, but you don't get paid for taking active risk. You expect to get paid for taking equity risk, the compensated form of risk. So as you build your investment policy, it's important to pay attention to those sort of differences.
So before you go further, we're at our 2-hour period. We need to take a break for the court reporter, so we'll reconvene at 11:25.
Thank you.